and debt levels were rising, but economic fundamentals were generally getting stronger, with rising investment and export orientation. Instead, as we know, Africa endured its first recession in 25 years as COVID-19 battered the world economy. After contracting by 1.9% last year, sub-Saharan Africa's economy is set to grow this year by 3.4%, according to the IMF, slower than other regions and well below the 6% global average. Africa embodies the two-track K-shaped recovery we increasingly see in the global economy. Advanced economies, China and a few others, are surging ahead, with other countries lagging behind. This K-shaped recovery is visible in the trade data as well. By 2022, African imports are set to be only 0.1% higher than in 2019, and exports about 2.3% higher. But import and export growth over the same 3-year period are set to be significantly stronger in Europe and North America, and several times higher for Asia, where imports are set to rise by 9% and exports by 12.5%. There are two main reasons African countries are being left behind in this crisis. The first is vaccine inequity. Africa has received 3.2 COVID-19 vaccine doses per 100 people, compared to 75 doses per 100 for people in developed countries. Beyond the intolerable implications for the health and well-being of individuals and families, low vaccination rates mean that economic life cannot fully resume, and African countries risk exclusion from global travel and related trade. The second is the lack of fiscal space and borrowing capacity to deploy in service of providing household and businesses economic relief and stimulus. Advanced economies have deployed fiscal and monetary support equivalent to about 25% of GDP since the beginning of 2020, according to the IMF. In low-income countries, the equivalent figure is under 3% of a much lower GDP. A new SDR allocation will allow poor countries to access short-term liquidity and will be amplified by reallocations and on-lending from advanced economies. As in previous crises, a familiar problem, the lack of diversification of our economies on the continent, made it harder to absorb and spread shocks across the spectrum of the economy. Debt to GDP ratios have increased in countries around the world, driven by the growth slowdown and the need to spend money on COVID-19 relief and response. But many African countries are particularly vulnerable to debt traps and serious fiscal sustainability problems. Even before the pandemic, debt levels had been rising, helped along by low borrowing costs. Already in 2019, several African countries had debt ratios of 100%, with many countries reaching levels not seen since the HIPC restructurings 15 to 20 years ago. Debt servicing costs had also become more burdensome. Debt service to revenue ratios were close to 19% in Ethiopia and Mozambique and 27% in Kenya. This meant fewer resources for productivity-enhancing investments in people and infrastructure. Even where debt to GDP or debt service to export ratios are not very high, tighter access to dollar financing because of the COVID-19 crisis means we're already seeing cases where scarce foreign exchange is going to fund debt repayment instead of capital investment. The World Bank IMF Debt Sustainability Framework assesses whether low-income countries have weak, strong, or medium debt carrying capacity, depending on their macroeconomic performance and policies. Higher debt carrying capacity means higher thresholds for debt distress. According to this framework in 2019, of the 37 low-income countries in Africa, only 7 had debt carrying capacity that could be characterized as strong. 17 were medium and 13 were weak. All 13 of the countries in the weak categories had public debt to GDP ratios exceeding their recommended threshold of 35%, often by a large margin. Of the 17 countries with medium debt carrying capacity, 7 had debt to GDP ratios close to or greater than the risk threshold of 55%. but only 3 exceeded it by a significant amount: Sao Tome and Principe, Ghana, and the Gambia. 6 of the 7 countries with strong debt carrying capacity had debt to GDP ratios below the 70% level considered safe. The pandemic has worsened debt burdens, particularly for the countries most vulnerable to debt distress. According to IMF estimates, countries with weak debt carrying capacity saw their average debt to GDP ratios increase by nearly 10 percentage points. Countries with medium carrying capacity saw their average ratio rise by about 4 percentage points, while those with strong carrying capacity jumped around 6 percentage points. In a paper this past spring, the IMF and World Bank warned that 54% of either countries were in or at high risk of debt distress, some facing interest burdens higher than pre-epic levels. Middle-income African countries have also seen their debt burdens increase sharply. Amid falling prices and reduced demand for oil worldwide, Nigeria's debt to GDP ratio rose from 29 to 35%, Algeria's from 46 to 53%, and Egypt's from 84 to 90%, Angola from 107 to 127%. Debt to GDP ratios also increased for non-oil exporters, including South Africa from 62 to 77%, Morocco from 65 to 76%, to name just a couple. For many countries, external debt service burdens threaten to impede their ability to support economic recovery and future growth. Debt restructuring and reprofiling are firmly back on the agenda. We know from experience that acting promptly and decisively is more effective for debtors and creditors alike. As I told a high-level UN event on the international debt architecture a few months ago, lost decades are a policy choice. The G20 Debt Service Suspension Initiative, DSSI, which allows low and lower middle-income countries to suspend payments to bilateral official creditors, has been extended through the rest of 2021. A longer extension would free up more revenue for the 32 African countries currently participating. The Common Framework for Debt Treatments, which has been endorsed by the Paris Club, opens the door to reprofiling and restructuring for countries when necessary. The involvement of private sector creditors is critical. While official debt remains predominant, the share of commercial debt went from 5 to 20% of the external debt of DSSI-eligible countries between 2010 and 2019. Chad, Ethiopia, and Zambia have requested debt treatment under the Common Framework. It may be time to revisit Kruger's idea of a sovereign debt restructuring mechanism, since the growing diversity of creditors incentivizes holdouts. Looking to the future, while the pandemic was certainly not the fault of African policymakers, it is clear that macroeconomic management needs to build in shock absorbers. This is where the ratios recommended by the IMF for debt to GDP or debt service to revenue can be useful. It's tempting to ignore such threshold when times are good, but they can help countries minimize disruptions when crises arise. We also need to manage our public finances much better. This means better governance. It means more transparency, the use of technology platforms for revenue management so as to minimize leakage. It means serious efforts to tackle corruption. And it means raising revenue domestically, including by closing corporate tax loopholes for multinationals. There have been promising steps forward on international tax cooperation in the OECD G20 process. The recent G7 agreement is significant because it would put a floor under tax competition. That said, many developing countries, including the African Tax Administration Forum, have concerns that the G7 proposals are necessarily complex and favor countries where multinationals tend to be headquartered. When thinking about how to use debt productively, it is paramount to think about how it is managed and what it is used for. Debt needs to go into high-yielding activities with high rates of return. As Director General of the WTO, you would not be surprised if I point to a link with trade. One potential area for high returns on investment is acting to lower what economists call trade costs, the costs associated with moving goods from the factory gate to the final consumer. This would raise the productive capacity of African economies, ultimately reducing real debt burdens, while helping build regional value chains and increasing the global competitiveness of firms on the continent. Currently, moving manufactured goods across international borders costs roughly 2.7 times more than moving the same goods across the same distance domestically. Costs are even higher for agricultural goods and services. Shipping and logistic expenses often account for a significant share of these costs and are a key factor in why trade costs between high-income countries are much lower than those among low-income economies. Managing trade costs in the context of open border initiatives like the African Continental Free Trade Area could be potentially transformative for the continent. Infrastructure and regulatory reforms that lower domestic and international trade costs could further generate sizable rates of return for both domestic firms and households. This would involve investments in hard infrastructure like ports, roads, and border posts, but also soft infrastructure like digitizing trade processes and improving the internet infrastructure underpinning e-commerce. There is also a strong case for innovation in debt management. New vehicles can bring lower cost development and trade financing without introducing systemic risks. One such idea is the UN Economic Commission for Africa's Liquidity and Sustainability Facility, LSF. Has proposed a partnership with major asset managers and multilateral development banks to try to lower government's borrowing costs by essentially creating a repurchase or repo market for holders of their sovereign bonds, akin to those that exist in advanced economies. Holders of sovereign bonds will be able to post them as collateral for low-interest loans. One possible avenue to seed capital for the Liquidity and Sustainability Facility could be through on-lending of some of the new 650 billion SDRs equivalent to be created by the IMF. By increasing demand for sovereign bonds, government's borrowing costs will be lowered and fiscal space expanded. In conclusion, I want to point to one thing pandemics and debt crises have in common. Prevention is better and cheaper than crisis management. But on both fronts, we tend to underinvest in preparedness. Debt management strategies in Africa need to build in the potential for external shocks and adverse events that constrain fiscal space and result in negative debt-related spillovers. But at the end of the day, we can't keep going through cycles of indebtedness, crisis, restructuring, and recovery. This is bad for long-term growth and living standards. We need to build in a sustainable way ahead. George Santayana's famous aphorism is particularly true when it comes to sovereign debt. Quote, "Those who cannot remember the past are condemned to repeat it," unquote. Thank you, ladies and gentlemen.